Hi everyone, Mark and John here from Bridgeport Asset Management, here to discuss a little bit about the new proposed changes with the new budget that has been passed down, specifically related to the change in how capital gains are taxed for both individuals and corporations. So John, why don't we talk a little bit about that and give us a walkthrough?
Yeah, so the capital gains has really been the main focus to date. Just to summarize, all the changes with the capital gains. Sort of what the budget says is that capital gains will now be 2/3 taxed inside a corporation. So anyone out there that has a holding corporation, any types of medical professionals, dentists that also earn income through their kind of professional corporation, those gains going forward will be taxed at 2/3 of the gain, whereas in the past they were taxed at 50% of the gain. That change is coming down as of the end of June, assuming that it goes through and is passed into law. The same is true for individual taxpayers, except the first $250,000 worth of gain that you have in a tax year, you will still get the 50% kind of inclusion rate on, but after 250,000 of gains, the 2/3 inclusion rate will apply. So effectively, what does this mean if you are subject to 2/3 of your gains being taxed? As an individual, just using very rough kind of numbers, when 50% of your gain is taxed, assuming that you're in the highest tax bracket, it means for every dollar of gain, approximately 25 or sort of 26 cents out of every dollar of gain you will pay in income tax. Going forward, that rate with the 2/3 inclusion rate and a 50% plus tax rate is closer to 34 or 35%. So really, you're paying about 9% more, or 9 cents on every dollar of gain going forward. So that's the key change. It's got a lot of people out there upset because they had been sort of counting on sort of realizing gains with that 50% inclusion rate when they bought stocks or when they bought, say, a property. The government's really saying that this will only affect uber wealthy sort of people out there, but in truth, it's actually going to catch a whole bunch of other people that don't necessarily consider themselves uber wealthy. For example, if you have a second property, it's a cottage, and you sell that for a gain of more than 250,000, assuming that you're holding that, individually, you will be subject to the higher tax rate. I think also many medical professionals, are in the same boat. They set up corporations so they could get a tax deferral, and now they will not, as the law currently stands, be able to benefit from the $250,000 threshold where you get the lower inclusion rate.
Okay, thanks for that explanation and rundown. Now, perhaps we can talk about what are the practical implications of these changes, and what should our clients and the general sort of client base be considering with these proposed changes?
So many people are asking whether they should be triggering capital gains prior to this end of June deadline. And their thinking there is that if they sell off investments prior to the end of June, they will get the 50% inclusion rate and will save about 9 cents on every dollar of kind of capital gains. They'll have about 9 cents of like tax savings. And, at a high level, you can see the overall appeal of that. Everyone likes to save tax. The issue is that you're prepaying tax now when you might not be even paying tax at the higher rate until several years in the future. So our general advice, I think, and we've talked a lot about this internally, as you know, is that unless you think that you are going to be selling your investment anyway in the next 6, 12, 18, or maybe even 24 months, we don't think you should sell your investments now, prepay tax just to save a little bit of tax later. What we think is it's sort of better to let your money continue to sort of compound on a tax-free basis until you sell, and sort of potentially pay the extra 9% somewhere down the line. It could be 6 years down the line, 10 years down the line, even 15 years down the line. So that's our baseline thinking. That being said, there are many tax accountants out there, tax lawyers out there, when we're sort of talking about businesses, pieces of real estate that are working on planning where they're doing estate freezes, crystallizing gains now, on the basis of not necessarily prepaying tax, sort of trying to lock in gains at a lower tax rate now. And that's something that if you have, very significant private assets, it's probably worth exploring. What we do think is important, and we've always thought is important, is when it comes to publicly traded portfolio, stocks, bonds, other assets, you definitely do not want to be over trading and crystallizing gains more than you have to be, because after June, that's going to be a lot more expensive. So I think that's a key piece. We've talked more and heard more about people using insurance inside corporations, which is an interesting sort of tax-free investment strategy, and we've been talking to clients about that. So I mean, all of those things are extremely important. We just feel like, generally speaking, it doesn't make sense, though, for people to sort of try to crystallize gains now and pay tax, unless, as we said, they are going to need that money anyway in the near future, and we're basically planning on selling in the near future.
So 2 big takeaways, I think, just perhaps avoid the knee-jerk reaction, really do your research, really do the research in terms of what the gains are, what your real plans for the money are, your time horizon. And this goes without saying, I think even before we were talking about this new change, high turnover investment strategies generally don't bode well or work well very often. However, that said, now even more to the point with the higher capital gains tax.
Actually, the other thing I'll say is too, obviously there's a lot of talk, and that, it seems that we're going to have a federal election coming up here in the next 12 or 18 months. We'll see, obviously, sort of what happens with that. But should we have a change of government, many people are speculating that sort of perhaps some of these rules might end up getting rolled back. Hard to say. You shouldn't do tax planning sort of based on that, but certainly one could see that there's the possibility of these rules being rolled back. Again, it just goes to may not be worth prepaying tax if, in fact, the rules get fully rolled back. It's also possible that the rules don't get fully rolled back, but they're tweaked. So we could see a new government say, hey, we don't think it's fair that individuals get the 50% inclusion rate on the first $250,000 of their gains, whereas corporations have to pay the 50% inclusion rate on the first dollar gain. So perhaps they'll put the $250,000 threshold in for all corporations. It's also possible they do something like they say, well, if you have a second property and you sell the second property, that's entitled to the 50% gain, or you get one shot at that in your lifetime, or there's all types of ways they could tweak this to make it less punitive for, what we'll call, upper income people, but not uber wealthy, ultra high net worth people, where you could see there could be some changes coming down.
Yeah, all very true. Thank you. Let's talk a little bit about something else that actually could be considered a positive aspect of what came out with the budget, and that's how a new tax advantage for entrepreneurs.
Sure. Yeah. So, I mean, currently, entrepreneurial businesses here in Canada, when an entrepreneur sells their shares in their business here, the first $1 million worth of capital gain on the sale of their shares is tax-free. The government has said they will increase that $1 million exemption. It's actually been $1,016,000, I think. They're going to increase that to $1.25 million. So that's a small benefit. In addition, what they've said is over the next decade, starting in 2025, they're going to scale up to allowing entrepreneurs the next $2 million of capital gains on the sale of their shares in their business. The next $2 million will be only taxed at 1/3. So that's even lower than it was in the past. It used to be 1/2, and now it's going down to 1/3. The catch is that the $2 million on top of the $1.25 million that attracts the 1/3 inclusion rate, they're only going to increase that by $200,000 a year starting in 2025. And by 2034, if we're here, we'll see the full $2 million will have been sort of phased in. So $200K times 10 years. And so if you sell your business in 2034, what the government is saying is at that point, your tax on gains of the sale of your shares in your small business, if it's under 6.25 million, they're saying that you're better off under these new rules than what you had under the old rules. Of course, that's 10 years hence. But anyway, that's at least a little bit of positive news, I think, for all of our entrepreneurial clients out there.
Yeah, it's a recognition of how important it is for job creation and entrepreneurs to succeed.
For sure.
So thank you for your time. I hope anybody has any questions for us. Just please feel free to visit the website. Our information is there, an email or a phone call. And we thank you.
Thanks.